Can you sell your life insurance policy? And how much can you get? This video is educational. It is not financial, tax, or legal advice. Citizens Life Group is a licensed life settlement brokerage. It is not a life settlement provider and does not buy policies. Reviewed by Jeff Hallman, Florida License 0266. Yes, a life insurance policy can be sold through a regulated transaction called a life settlement. In 2025, the average reported payout was $212,066. That figure comes from the Life Insurance Settlement Association, known as LISA, in its 2025 annual market data, released May 19, 2026. The legal basis is more than a century old. In Grigsby versus Russell, decided in 1911, the United States Supreme Court ruled that a life insurance policy is transferable personal property. An owner can sell a policy the way an owner can sell a house or shares of stock. The transaction is regulated, not informal. LISA reports that 90% of the United States population lives in states with comprehensive life settlement laws, and 43 states regulate the transaction directly. Florida regulates it under Chapter 626 of the Florida statutes, overseen by the Florida Office of Insurance Regulation. In Florida statute, these transactions are called Viatical settlements, and one framework covers sales by both healthy and terminally ill insureds. Sellers generally qualify at age 65 or older with $100,000 or more in face value. LISA reports those as the common thresholds and notes that some purchasers consider smaller policies. Universal life, whole life, and variable life commonly qualify. Convertible term qualifies while the conversion option is still open, and some purchasers also consider group life and federal employees group life insurance. The owner of the policy is the seller. That can be the insured personally, a trust, or a business. And the owner signs the settlement contract and receives the proceeds. Health is the other gatekeeper. A decline in health since the policy was issued generally improves an offer because the buyer projects a shorter premium paying period. Two insureds holding identical policies can receive very different offers for that reason. LISA's 2025 market data reports an average life settlement payout of $212,066. The same release, dated May 19, 2026, puts the average cash surrender value at $24,360. Sellers received nearly 9 times what their insurers offered for surrender, and the average surrender itself fell 27% from $33,493 in 2024. The totals are large. LISA members paid $626.6 million to consumers across 2,955 completed transactions in 2025, a 9.48% increase over 2024, and $554.6 million more than surrender would have paid. From 2021 through 2025, LISA reports $3.6 billion paid to consumers on nearly 15,000 policies, roughly $3 billion above surrender value. The multiple is rising. LISA's own series shows 6.2 times cash surrender value in its 2023 data, roughly 6.5 times in 2024, and nearly 9 times in 2025. Published ranges elsewhere run wider and lower, and most carry no methodology. One widely used industry guideline cuts through the spread. Offers run 10 to 25% of a policy's face value. 3 drivers explain why offers vary: the insured's life expectancy, the policy type, and the ongoing premium cost required to keep the policy in force. A shorter life expectancy, a lower premium load, and a flexible policy design each support a higher offer. Individual results vary, and there is no guarantee that every applicant receives an offer. State-licensed life settlement providers buy the policies, funded by institutional investors such as pension funds and asset managers. Each provider holds a license in the states where it purchases, and license status can be verified through the state insurance department. In Florida, that regulator is the Florida Office of Insurance Regulation. A seller faces one structural choice: accept a single provider's direct offer or Have a licensed broker run a competitive auction among multiple providers. The difference is legal, not cosmetic. Under Florida Statute 626.9911(4), a broker owes a fiduciary duty exclusively to the policy owner. Section 2, B, of the Life Settlements Model Act from the National Council of Insurance Legislators, or NCOIL, readopted November 24, 2024, imposes the same duty. A provider owes no such duty. It buys for its investors. The broker is compensated by commission from the settlement proceeds under each state's statute. Many states cap the commission at the lower of 8% of face value or 30% of the settlement amount. Written disclosure of the commission is required before the owner signs, and there is zero out-of-pocket cost to the senior. The investor side of this market has drawn federal attention. The Securities and Exchange Commission's Life Settlements Task Force reported on July 22, 2010, and the SEC published an investor bulletin on January 20, 2011. Both address people who buy settlements as investments, not sellers. That depends on one question. Is the coverage still needed by the people it protects? When the answer is yes, keeping the policy usually wins. When the answer is no, the policy is an asset with a market value worth checking. State law frames the decision. Florida Statute 626.9923 and Section 8 of the NCOIL Model Act require that owners be informed of alternatives before a settlement closes. There are 6: an accelerated death benefit, a policy loan, reduced paid-up insurance, a 1035 exchange under Internal Revenue Code Section 1035, surrender, and lapse. Each keeps some or all of the value inside the insurance framework, and each fits a different situation. Taxes belong in the decision. IRS Revenue Ruling 2009-13 and Revenue Ruling 2020-05, applying the Tax Cuts and Jobs Act of 2017, set a 3-tier framework. In general terms, proceeds up to the owner's basis are not taxed. The portion from basis up to cash surrender value is taxed as ordinary income, and amounts above that are taxed as capital gain. The buyer and the insurer report the sale on Forms 1099-LS and 1099-SB. A tax advisor should review the numbers for any specific policy. Public benefits belong in the decision as well. A lump sum can affect eligibility for needs-based programs such as Medicaid. An elder law attorney or a benefits counselor should review eligibility before any sale closes. The process typically runs 60 to 90 days from first contact to funds in hand. Citizens Life Group's published process timeline, current as of 2026, reports the same range. The work happens in 3 phases. Phase 1 is qualification, usually 1 to 3 days. The application, a medical records release, and current policy statements, or an in-force illustration. Phase 2 is underwriting and bidding, usually 4 to 8 weeks. Independent life expectancy underwriters review the medical records, providers price the policy, and in a brokered case, multiple providers bid against one another. Phase 3 is closing, usually 2 to 4 weeks. The closing package is signed and notarized. The insurer records the change of ownership and beneficiary, and the funds sit with an independent escrow agent until the transfer is confirmed. The escrow agent then releases payment to the seller. The sale is not final the moment the money arrives. Florida Statute 626.9924 gives the seller an unconditional right to rescind for 15 days after receiving the proceeds. Other states differ, and versions of the Viatical Settlements Model Act from the National Association of Insurance Commissioners, NAIC Model 697, allow up to 60 days. Rescinding means returning the money and keeping the policy. The biggest mistake is lapsing a policy without checking its market value first. The scale of that mistake has been measured. Gottlieb and Smetters, writing in the American Economic Review in 2021, cite Milliman data on lapse rates. They found that 76% of universal life policies sold to seniors at age 65 never pay a death claim. Nearly 88% of universal life policies overall do not end in a death benefit claim. Rising cost of insurance charges drive many of those lapses. A separate video on this channel covers why universal life premiums increase. Awareness compounds the problem. A survey prepared for the Insurance Studies Institute in 2010 found that 90% of seniors who lapsed a policy would have considered selling had they known the option existed. The second mistake is surrendering without a market comparison. LISA's 2025 data put the average surrender at $24,360 against the average settlement of $212,066. The third mistake is accepting a single direct offer without competition. In one documented industry case, a policy owner held a direct buyer's offer of $20,000. A brokered auction settled the same policy at $1,200,000, 60 times the direct offer. Industry reported 2021 pricing data points the same direction. The largest direct buyer paid an average of 16.7% of face value, while broker-facilitated transactions averaged above 20%. The fourth mistake is letting a term conversion deadline pass. A convertible term policy can qualify for settlement, but only while the conversion window is open. After the deadline, the asset is gone. 5 quick answers before the end card. Is selling a policy legal? Yes. The authority dates to Grigsby versus Russell in 1911, and 43 states regulate the transaction today. How long does it take? Typically 60 to 90 days from first contact to funds. Who pays the broker? The commission comes out of the settlement proceeds under state statute with zero out-of-pocket cost to the senior. Are the proceeds taxable? Often in part, under Revenue Rulings 2009-13 and 2020-05, a tax advisor should review any specific case. Where can a license be checked? With the State Insurance Department. In Florida, the Office of Insurance Regulation. Chapter timestamps, every source with its date, and the companion article are listed in the description. This video is educational. It is not financial, tax, or legal advice.